Hi everybody. In this set of videos, we're going to be looking at some labor supply and demand problems, seeing how the labor-leisure model of labor-leisure choice will affect hours worked or hours spent in leisure with various economic policies. So in this video, we'll be looking at how welfare programs will affect labor-leisure choice. And then we'll go through several more examples from the labor supply side and then several examples from the labor demand side. So starting here with the welfare program, we'll have a cash grant where the recipient, if they are not working, they receive $1,000 per week. And then the government would assume that if you start to work, you don't need the grant anymore, so the grant goes away. So we'll look at both cases of whether a person is working, and then whether the person receives the grant, and see how those change. So we'll start here drawing the axes of the labor-leisure choice: consumption, hours of leisure, and then down here we have H, hours of labor. Okay, and so if, say, there were 110 total hours available in a week, you could spend all of your time on leisure with no time left for labor, or vice versa. And then to get our budget line, we'll use the consumption function. Consumption is a function of your wage times hours worked plus any non-labor income. The other way we can write that is the wage times total hours available minus your hours of leisure. That's just your hours worked plus non-labor income. Okay, so let's start with a scenario where the person is not working at all, and they have some wage, right? The slope of this line is the wage. It's actually the negative of the slope of that line. And then they're going to be optimizing their utility subject to that budget constraint. And so we'll call this U0. With the initial tangency point here, let's say that's putting them in a 40-hour work week. Okay, so then let's see the effect of the cash grant. So $1,000 per week, that's going to increase non-labor income, V. So that'll come up, and it's just going to be, some level of income, 1,000. And they'll receive that if they're not working. There's no effect on the wage, so the wage will still be the same slope, right? So W1 is equal to W0, no change there. And then this person will be maximizing their utility at this tangency point here. So let's go ahead and call this point G. Let's call that initial point P. And so we see that if the non-labor income increases, then that utility curve is going to be pushed out, and we can imagine that it would be pushed out to a position where the person is not working anymore, or at the very least they would be working less, right? So it could be in here, but but we'll go ahead and draw it so that it's tangent to this point G. Okay, so the effect there then is the worker moves from point P point G and is encouraged or incentivized to exit the labor force. Okay, and so, yeah, if you had a cash grant type of program that was a take it or leave it, you would have this disincentive to be a part of the labor force. So then, an alternative to that could result in something like this second question, where the government changes the program a bit and creates a cash grant program that allows employment. And so if you're not working, again, they will receive $1,000. So if in this case, Sam not working at all, total income will be $1,000. But then the effect of this policy is that, okay, suppose the government takes away 50 cents for every dollar that you earn on the labor market. So if this person, Sam, earns $10 an hour, and they decide to work 1 hour, they'll get their $1,000 cash grant plus their $10 from their labor, but the government takes away $5 from their grant. So it's really like a $995 grant instead of a $1,000 grant. And so total income there comes out to $1,005. If they work 2 hours, right, they get their $1,000 cash grant plus $20 of wage income minus half of that from their grant, so $1,010. So that's the gist of how this setup is going to be. And there's a way to think about it in terms of instead of taking away from the grant, it's really in effect creating a tax on the wages. So in effect, the government is actually taxing the welfare recipients at a rate of 50%. So the government is actually taxing the welfare recipients at a rate of 50%. They're taxing their wages, essentially, at a rate of 50%. So if they would actually be receiving $10 an hour in the market, effectively, this welfare program is making it as if they are making $5 per hour. Okay, so they can still work and receive an income, but that's partially taxed. And so this change in the wage is going to represent itself in a slope on this labor-leisure model. So again, we'll do the same thing, draw an initial setup for the labor-leisure model before the program and after. So we have consumption and leisure. Supposed to be a straight line there for the budget constraint. All right, 110 hours. They will maximize their utility to 0. Let's call this initial endowment E, right? They're not receiving any cash grant at the beginning. The wage is $10, so the slope there is -10. And they're going to start out here at point P. Okay, now the effect of the program, all right, before the program, they start out at point P. So what does the program do? One, it changes the endowment point. So we're going to go from this point E up to some point that we'll call G. Okay, so we move from E of $0 of endowment to G, $1,000 endowment from the cash grant. Okay, but then the second thing that it's doing here is changing the slope of that budget line to the net wage rate. So it's effectively cutting the wage in half, from 10 to 5. So that government program is going to cut this slope in half. We can call this W1. It's 5. Slope there is -5. And what's going to happen now is the person will be able to increase their utility by increasing their difference curve to end up somewhere on the budget constraint here, and we'll call this point R. And so if initially at point P they were working 40 hours and having 70 hours of leisure per week, then after this new cash grant program kicks in, maybe they're at a point of, say, 100. Numbers are somewhat arbitrary, but directionally, this is what will happen. Okay, so after the program, we end up at point R. So they're not going to totally drop out of the labor force because they can still earn a bit of wage income, labor income, but they're not going to be working quite as much as they were initially over here at point P. All right, so this is one way that we can see sort of the end result. We do end up ultimately going from P to R, but we can dichotomize that effect into the income and the substitution effects. So if we scroll down and remember about the income and substitution effects, let's write down a couple things and then see what these look like on the graph. So remember, the income effect increases the demand for leisure. It actually increases the demand for leisure and consumption, but the main idea here is going to be related to leisure. So it increases demand for leisure. That's because both leisure and consumption goods are normal goods. Okay, so leisure is a normal good. And the way we can observe that income effect on the graph is by taking this initial budget line, right, from F down to E, and we know that we end up here at point R on this second indifference curve, U1. So we can take that initial wage and find out where it would have ended up if it would have been a parallel shift. So that would be about here, right, where the initial wage was 10. So if we ended up on the new budget line and the wage was still 10, then we could end up in a point like this. And we see that we do have a higher level of consumption, and we do also have a higher level of leisure. Those have both gone up because they're both normal goods. So let's call this point Q. And so we know that this is definitely, it's necessarily going to increase the hours of leisure because it is a normal good. And so that income effect, it's going to move us from point P to Q, and because of this fact, that leisure is a normal good, Q is necessarily to the right of P. So the income effect will definitely have an increase of leisure. Okay, the substitution effect comes from now that there's a different wage. This new wage is 5. So that's ultimately changing around the relative prices of labor and leisure. We can write a couple things about that. So induced by the extra effective tax on labor earnings, induced by the extra effective tax on earnings. It's not a direct tax, but effectively it is a tax. This is going to reduce the price of leisure. So the price of leisure is reduced. Right? Beforehand, if you wanted to spend an hour of leisure, you were going to give up $10 per hour that you could have been making in the labor market, essentially the opportunity cost. Now you're only giving up $5. So your price of leisure has been reduced from 10 to 5. So now it's cheaper to have more leisure. So you're going to see this substitution effect represented in the movement from Q to R. So this is from Q to R. And again, because it is now relatively speaking cheaper, R is necessarily to the right of Q. Okay, and so we know that R is necessarily to the right of Q, and we know that Q is necessarily to the right of P. So therefore, the effect of this welfare program that includes both a cash grant and a tax on labor earnings, the result is that it necessarily reduces hours of work. Okay, so ultimately, it's the program itself, it's the welfare system and incentives built into it that create the incentives for the people in those programs to work less. Right? It's not necessarily something about the person, but it's their response to the incentives created by the program. So there's a little nuance there to think about some of these sociological aspects of the policy. And so that's the effect of two welfare programs. One is the simple cash grant. One is the cash grant with the effective tax on earnings. So in the next video, we're going to pick up with some other problems, and then we'll go from there. So thanks.